Hello, let us get to understand what we refer to as cost of sales, or rather commonly known as cost of goods sold as well, okay? So cost of sales is basically the carrying amount of the inventory that you have sold, okay? So we recognize this cost of sales. One thing you should know, this is an expense to the business. This is an expense to the business, and it is recognized at the point of sale. The moment you sell this inventory, then you recognize this expense, okay? So you've gone, for example, as a business, you've bought goods worth $4,000, okay? So as at that particular point, what do? You record that as inventory. That is your stock. It is sitting whether in your shelves or in your warehouse. That is inventory. How do we record the journal entries for this? We come and debit inventory to show that there is an increase in your stock, okay? We debit inventory account and credit. For example, if you paid with cash, we are going to create credit cash account. If you took on credit, then we're going to credit account payable to create a liability, an obligation to pay this amount of money to your supplier, okay? So as at this point, when the stock is sitting in your warehouse or your office, we record it as inventory, and this is an asset account. This is a current asset account, okay? So what happens when we sell? What happens when we sell this inventory? At the point of sale, the cost of buying those goods, which is this $4,000, is going to be recognized as the cost of sale. It is going to be recognized as the cost of sale, okay? So this $4,000 is going to be recognized as cost of sale. For example, let's say these goods, you bought them at 4,000, but now you have sold them at, let's say 8,000, okay? So this is a revenue. This is revenue, okay? And then 4,000 is the cost you incurred to buy those goods that you've sold, and that is what we are calling here cost of sale, okay? From it, you usually get the gross profit. But one thing to note is we recognize the cost of sale at the point of sale. That point that you have, the moment you sell, that is when you recognize the cost of sale. Otherwise, as long as those goods are sitting in your office or your warehouse, we call that is basically inventory. And why are we recognizing cost of sales at the point of sale? Because of the matching principle. The matching principle expects us to the revenue and the cost incurred to earn that revenue should be recognized in the same accounting period. So when you recognize revenue, you make sure you recognize as well the cost that you have incurred to earn that revenue. And one of the direct costs that you incurred to earn revenue, it's either the money that you've used to buy those goods that you have sold or to manufacture those goods that you have sold, okay? So the matching principle is the one that guides us to make sure we recognize the cost of sales at the point when we make that sale, okay? The moment we earn that revenue, okay? So another thing I want us to look at is the inventory system. We have two types of inventory system, which is the periodic system and the perpetual system. And basically what causes the difference is when at which point do we record, not recognize, but at which point do we record the cost of sales? Remember, we recognize the cost of sale as at that particular point of when we are selling. That is when we should recognize cost of sale for each. But then we have an option of recording it as at that particular point. That is the perpetual system. Or we record it at the end of that accounting period, as long as we will still meet the matching principle, because as long as we are looking at a certain accounting period, by the end of that accounting period, we are able to see this is the revenue that we've earned during the period, and this is the cost of sales that we've earned, that we have incurred during that period. So in this case, the periodic system, we calculate the cost of sales at the end, okay? The cost of sale is still going to be recognized as at that particular point, but we can record it when you are doing the period end adjustment. But for perpetual here, you will find that the accountant is there's an account called the cost of sales, that at the point of sale, when we make that sale, we are able to record the cost of sale. So we are making this adjustment to the cost of sale account. Okay, what do we mean by this? What do we mean by this? Let us first look at the perpetual inventory system. The cost of the goods, as mentioned, or rather the cost of sale, is recorded at the point of sale. So in this case, let's say, for example, business sold 10 televisions at $20,000 each, which were bought at $10,000 each. Remember, I said the cost of sale is not the selling price. No, it is the cost that you have incurred to buy those goods that you have sold. So in our case here, we are being told business sold 10 televisions at 20,000. That one should tell you that is a revenue. That is a revenue, okay? So, but these televisions were bought at 10,000 each. So our cost of sale is basically the cost we incurred to buy these televisions, which is $10,000 multiplied by 10, okay? So that is basically $100,000, okay? So basically, this is the cost that you have incurred to buy the televisions, okay? And that is the cost of sale, because as at this point, the sale has happened. So how do we record this? So remember, the moment you do that sale, let's say you have been paid, you've been paid in cash. So what are you going, you will have received cash, okay? You will have received cash. So your cash account has increased by 100,000, okay? 100,000. And what will happen on the other end? You need to recognize a revenue. So we'll have sales revenue account, okay? An amount of 100,000, okay? Then you are going to recognize the expense. Remember, you need to recognize the cost you have incurred to earn that revenue. So here we come and debit the cost of sale, which, as mentioned, is mentioned earlier, it is an expense account. Okay, that is why we are debiting. So an amount of 100,000, and then we're going to credit. We are going to credit inventory to reduce now that inventory that we had of an amount of 100,000, because now it has been sold. Okay, so basically these are the journal entries that will be passed over time for a perpetual inventory system. So at the end of the accounting period, we are able to see the expense that is the cost of sale that has been incurred during that accounting period, that the expense that has been incurred during that accounting period. So this one, basically at the end, there is no need for adjustment. This is basically we already know the cost of sale, or rather the expense that has been incurred to buy the goods that have been sold. So that is a perpetual inventory system. So in the next video, I want to show you how we do the periodic inventory system, which is very common and very key. Okay, so see you in the next video.